Americans are quite familiar with debt. On average, each person in the US has about $100,000 in debt. Now, this isn't just random spending. Many people borrow money to invest in their future, like buying a house, paying for education, or starting a business. These are all smart ways to use debt because they can help you reach your personal and financial goals. But have you ever thought about borrowing money to invest in things like stocks, bonds, and investment funds? It might sound a bit strange at first, but it can be a smart move if done carefully. Think of it like this: you borrow money today, invest it wisely, and aim for returns that are higher than the interest you pay on the loan. If everything goes well, you could make a nice profit. It's like planting seeds today to enjoy the fruits tomorrow. In this video, we're going to break it all down for you. We'll explain how you can leverage debt and how it works when you borrow and invest. We'll cover the basics and give you practical tips so you can understand how to use this strategy wisely. And if you're new to our channel, don't forget to subscribe and hit the bell icon so you won't miss out on the valuable insights we share in our future videos. Getting back to the video, first of all, let's talk about the concept of leveraging debt. Leveraging simply means using borrowed money to increase the potential return of an investment. It's like using a lever to lift something heavy with less effort. In finance, you're using someone else's money to try to boost your investment gains. Now, why would you want to do this? Well, if the investment you make earns more than the cost of the debt, the interest you pay, you come out ahead. For example, let's say you borrow $10,000 at a 5% interest rate and invest it in a stock portfolio that earns 8% over the year. After paying the interest, you're left with a 3% profit on the borrowed money. But remember, this strategy comes with risks. If your investments don't perform well, you still have to pay back the loan with interest, which could leave you in a worse financial position. So, it's crucial to understand the risks and have a solid plan. 2. Understanding good debt and bad debt. Now, to make sense of leveraging debt, we first need to understand the difference between good debt and bad debt. So, let's break it down in simple terms. Good debt is the kind of borrowing that helps you build long-term wealth. It's like borrowing money to buy a house that will likely increase in value over time, or taking out a loan for education that can lead to a higher-paying job. These are investments in your future that can pay off significantly in the long run. On the flip side, bad debt is the type that can harm your credit and drain your finances. It's risky and often comes with high costs. A classic example of bad debt is credit card debt. The average American carries almost $6,000 in credit card balances, and these cards usually come with high interest rates, making it expensive to pay off over time. Another common example of bad debt is car loans. When you borrow money to buy a car, you're purchasing something that loses value over time. Cars depreciate quickly, meaning they're worth less and less each year. So, while you're paying off the loan, the car's value is dropping, which isn't a great financial move. In general, borrowing money to cover ongoing living expenses is also considered bad debt. It doesn't help you build wealth or improve your financial situation in the long run. It's like using a band-aid for a problem that needs a long-term solution. So, how does this all connect to leveraging debt for investing? Well, the idea is to use good debt strategically to make smart investments. For example, you might take out a low-interest loan to invest in stocks, bonds, or real estate that has the potential to grow in value. If your investments earn more than the interest you're paying on the loan, you come out ahead. By differentiating between good and bad debt and understanding your risk tolerance, you can make informed decisions that help you reach your financial goals. So, let's dive deeper and explore how you can use this strategy effectively. 3. How it works. Borrowing to invest can enable an investor to amplify their returns by leveraging their capital invested. But is it really worthwhile? The answer depends on various factors, including the time period you choose to examine. If we look back historically, the long-term average prime lending rate in the US, specifically the S&P 500, has generated an impressive 11.4% annualized return, including reinvested dividends, as of 2024. So, what does this mean for borrowing to invest? Essentially, if your investments can earn a return higher than the interest rate on your loan, you could come out ahead. This potential to earn more on your investments than the cost of your debt is what makes leveraging debt an attractive strategy for many investors. Student loans are a classic example of good debt because they can lead to higher earnings over your career. But that's just the beginning. Good debt helps you accomplish important objectives or avoid negative outcomes. Consider another example, taking out a mortgage to buy a home. Most people can't afford to pay for a house outright, and even if you could, taking on a mortgage has its advantages. Paying down a mortgage builds equity in your home and can offer potential tax benefits. Plus, if you make your monthly payments consistently, it can improve your credit score. This makes mortgages a solid example of good debt. Now, let's bring it back to leveraged investing. Imagine you have $100 to invest with an expected 10% return. If you use your own money, you'd earn $10. But what if you invested $50 of your own money and borrowed the other $50? If the interest on the loan is less than 10%, you'd end up earning more because you've leveraged your return. Another effective strategy involves using a loan to diversify your investment portfolio. This is especially useful for individuals who hold a large stock position in a single company. By borrowing against that concentrated position, they can invest in other stocks, creating a more balanced long-term investment strategy. An added benefit here is that you may defer paying capital gains tax, which you would incur if you sold the concentrated stock. 4. Avoiding bad outcomes. Alright, let's move on to another key aspect of leveraging debt. How good debt can help you avoid bad outcomes. This is an important part of understanding when borrowing to invest makes sense. Let's share a story to understand this. Imagine you have a client, let's call him John. John owed a large tax payment due on April 15th, but he wasn't expecting a significant cash payment until June. He had two options. He could sell off some assets in his investment portfolio to cover the tax bill, or he could find another way to get the money. Selling assets would mean not only paying transaction costs, but also potentially disrupting his carefully constructed portfolio and incurring more taxes. Instead, John decided to take out a short-term loan to pay the tax bill, and then repaid the loan in June when he received his expected cash. This strategy allowed John to avoid disrupting his investment portfolio, showing how debt can be used effectively to navigate financial challenges. Now let's link this to our previous discussion on good and bad debt. We talked about how good debt can help you build long-term wealth, but it can also help you avoid bad financial outcomes, like having to sell investments at an inconvenient time or paying hefty transaction fees. Another strategy to consider is using income generated from diversified investments to pay down bad debts. Let's say you have several high-interest credit card debts, which we know are bad debts because of their high costs. If you've assessed your financial situation and determined the amount of bad debt you're carrying, it might make sense to sell off an asset to quickly pay down those debts. This can save you money in the long run by reducing the interest you're paying. Your personal tolerance for debt plays a big role here. Some people are comfortable carrying a certain amount of debt, while others prefer to minimize it as much as possible. Knowing your own comfort level with debt can help you make smarter financial decisions. 5. Assessing your debt tolerance. Finally, the last crucial aspect of leveraging debt is to know about your debt tolerance. This is key to understanding when borrowing to invest makes sense. Your comfort level with a given amount of debt depends largely on your tolerance for risk. It's essential to understand the potential downsides of taking on debt so you can determine how comfortable you are with that risk. Imagine you're thinking about borrowing money to diversify your investment portfolio. Are you prepared to weather a volatile market? This means being ready to hold onto your investments even if their value fluctuates significantly in the short term. Another factor to consider is your time horizon. For instance, are you committed to paying off an investment-related debt within 2 years? Or are you okay if it takes longer? These kinds of questions can help you assess your comfort level with debt as part of your investment strategy. Debt tolerance is unique to each person. Some might feel comfortable taking on more debt because they have a steady income and a high tolerance for risk. Others might prefer to minimize debt due to a lower risk tolerance or a variable income. It's crucial to look at your cash flow and ensure you have enough income to service your debt. This means being able to make your debt payments without straining your finances. Determining the right amount of good debt to take on is more of an art than a science. It's about balancing the potential benefits of leveraging debt with your personal comfort level and financial situation. There's no one-size-fits-all answer, and what works for one person might not work for another. Alright, we've covered a lot of ground today on leveraging debt and when borrowing to invest makes sense. Before we wrap up, Remember that leveraging debt is a powerful tool, but it comes with risks. Always do your homework, assess your risk tolerance, and consider speaking with a financial professional to ensure you're making the best decisions for your unique situation. If you found this video helpful, make sure to hit that subscribe button so you don't miss out on our future videos. We're here to provide you with the tips and insights you need to make smart financial decisions. Also, if you have any questions or topics you'd like us to cover, leave a comment below. We love hearing from you. Thank you so much for watching. Don't forget to like, share, and subscribe to our channel. We appreciate your support and look forward to seeing you in the next video. Take care and happy investing.